This is your technical update from the LMAX Exchange Research and Analytics Desk for Monday, December 7th, 2015. Eurodollar. So the euro rally from last week, that impressive surge, has stalled out by the 38.2% fib retracement off of the August high to December low move. At this point, the market is still confined to a broader downtrend and look for a lower top to carve out somewhere around this 38.2% fib retracement in favor of the next major downside extension back below the recent low that we saw last week at 105.21 and towards the 104.60 area multi-year low from March. Sterling dollar. So cable continues to put in a series of lower tops and lower lows off that 2015 high, with the next lower top now sought out somewhere ahead of 153.35 in favor of the next downside extension towards the 2015 base at 145.66. At this point, look for any rallies to be well capped ahead of 153.36, with only a break back above that previous lower top to negate the current downward momentum. Dollar yen. So dollar yen has been chopping around and remains confined to some consolidation between 123.75 above and 122.20 below. A break above 123.75 would open the door for a retest of the 2015 multi-year high at 125.85, while inability to take out 23.75 followed by a break back below 122.20 would put the pressure back on the downside and open the door for an acceleration back towards the 119 to 120 area. Euro Swiss. So Euro Swiss has been confined to a multi-day, multi-week consolidation, though the market continues to be confined to a broader recovery structure off that record low from earlier this year. At this point, a market should continue to be very well supported on dips ahead of 107, with a fresh upside extension seen back above 110.50 and towards 112 further up. Aussie dollar. So Aussie has come back into some key resistance around the 74 area, but rallies continue to stall out just shy of 74, and while the market holds below this figure on a close basis, the overall structure continues to favor additional weakness back towards the multi-year low just shy of 69. At this point, only a close above 74 would really compromise the immediate bearish outlook. Dollar CAD. So dollar CAD continues to trade just off that 11-year peak from September at 134.57, and the market is confined to an intense bullish structure which favors an eventual break above 134.57, exposing 140 further up. At this point, any setback should be very well supported into the 130 area, while only back below 128 would really compromise the highly constructive outlook for dollar CAD. Kiwi dollar. So although we've seen a bit of a bounce in Kiwi in recent trade, the market is confined to a broader downtrend, and a medium-term lower top is now sought out by that high that we saw going back to the month of October, which came in just shy of 69. At this point, deeper setback should be favored back towards the August base in the 62 area, with only a close back above 69 to really compromise the bearish outlook for Kiwi dollar. SPX 500. So the S&P 500 has been chopping around since stalling out at 2117, just shy of the 2137 record high from May. At this point, a break above 2117 would be required to open the door for fresh upside towards that record high and beyond, while inability to break above 2117 followed by a break back below the 2003 area would confirm the potential for a major top and open the door for an acceleration of declines. Gold. So gold is finally showing some signs of a base after the market traded down to a fresh multi-year low last week at 1046. At this point, though, the market will need to establish back above 1100 to officially take the pressure off the downside and open the door for a more significant rally in this market. Inability to establish back above 1100 would suggest that the market is still favoring the downside, which could expose an eventual drop below 1046 towards major psychological barriers at 1000 further down.